Picture this. A family sits down for dinner and Grandpa announces he's just taken out a 100-year loan. Nobody in the room will be alive when it's due. His grandchildren's grandchildren will inherit the payments, not the party. That's not hypothetical. That's literally how the United Kingdom financed its wars for 3 centuries. And it's still, in one form or another, how almost every government on Earth pays its bills today. Welcome back. Today we're not asking how much debt does the world have. We're asking a much stranger question. What happens to a debt that is never, ever meant to be paid off? Because once you understand that answer, you'll never look at a national budget the same way again. Let's start with a number that should stop you in your tracks. In 1917, Britain issued something called War Loan, a bond sold to ordinary citizens to fund the fight against Germany. It promised annual interest forever with no fixed repayment date. Grandparents bought it, their children inherited it. Their grandchildren inherited it too. It wasn't fully retired until 2015, nearly 100 years after the guns fell silent. Think about that. A debt from the era of horse cavalry was still on the books when smartphones already had face recognition. That's not a bug in the system. That, as we'll see, is the system working exactly as designed. And Britain's war loan wasn't even the strangest example of debt outliving its purpose. Some of the bonds it eventually replaced traced their lineage back even further, to loans first issued in the 1700s and simply renamed generation after generation. In other words, Britain was still quietly servicing echoes of debt from the age of powdered wigs almost into the smartphone era. Most people assume a loan is simple. You borrow, you repay, the story ends. Governments broke that story a long time ago, and they broke it on purpose. To understand why, we need to look at debt not as an accident of bad budgeting, but as a deliberately engineered machine. A machine with gears, levers, and a very specific kind of fuel, belief. So let's open it up and look inside. First gear, the illusion of the lump sum. When you hear the U.S. owes $38 trillion, your brain pictures a single giant bill sitting on a desk somewhere waiting to be paid. That image is completely wrong, and it's the first thing we need to demolish. There is no bill. There's no due date for the whole amount. There never was. What actually exists is millions of separate bonds, each with its own maturity, some due in a month, some in 30 years. Every single day, some of those bonds come due. And every single day, the government sells new ones to cover them. It's less like a mortgage and more like a subscription service that auto-renews itself forever in the background. You don't pay off Netflix. You just keep paying the monthly fee for as long as you want the show to keep playing. National debt works the same way, except the show is the entire modern economy. And just like a subscription, the price of admission can quietly change without anyone renegotiating the whole contract. Raise interest rates by even 0.5%, and the monthly fee on trillions of dollars of debt jumps by staggering amounts, almost invisibly in the background of ordinary life. Second gear, the compounding trick nobody tells you about. Here's something wild. Economists have a name for the moment a country's debt becomes mathematically self-sustaining, even while growing. It's called the R-G condition. If the economy's growth rate stays close to or above the interest rate on the debt can expand in dollar terms while actually shrinking relative to the size of the economy. In plain English, you can owe more money every single year and still be getting healthier, as long as your income grows faster than your debt payments. This is exactly how a 20-something with a growing salary can take on a bigger mortgage every few years and still improve their financial position. It's not reckless, it's arithmetic, but it only works while growth cooperates. And that's the trapdoor hiding under the whole system. Because growth doesn't always cooperate, and when it stalls, the very same math starts running in reverse. Quietly, at first, and then all at once. Let's talk about a case most people have never heard of, because it doesn't involve America, China, or Europe. Let's talk about Lebanon. For years, Lebanese banks offered depositors sky-high interest rates, sometimes over 10%, to keep dollars flowing into the country. The government borrowed heavily against those deposits to keep the lights on. It worked. Right up until October 2019, when confidence finally cracked. Depositors tried to withdraw their own money and simply couldn't. Banks froze accounts. The currency lost over 90% of its value within a few years. People who had a comfortable middle-class life in dollars woke up to find their entire life savings functionally worthless. Doctors, engineers, university professors, people who had spent decades building careers suddenly couldn't afford basic groceries with the same money that once paid rent. Long lines formed outside gas stations because importers couldn't get the foreign currency to pay for fuel shipments. Hospitals rationed medicine. Families who had saved for their children's education watched those savings evaporate almost overnight. This wasn't a natural disaster. There was no war, no famine, no earthquake. It was a confidence machine running out of confidence, and the whole structure came down almost overnight. Lebanon is small, so the world barely noticed. But the mechanism that broke there is the exact same mechanism holding up the debt of every major economy today. Which brings us to the real question this video wants to answer. If debt is never meant to be repaid, and it's simply rolled over generation after generation, then what actually backs it? What stops the whole planet from turning into Lebanon at the same time? The answer is uncomfortable. Nothing backs it except the willingness of the next buyer to show up. That's it. That's the entire foundation. Not gold, not oil, not factories, just a continuous queue of buyers willing to purchase the next round of bonds. And here's the part that should genuinely unsettle you. That queue isn't infinite, and it isn't guaranteed. Let's look at a completely different kind of debt trap, one hiding inside the world's second largest economy. China doesn't have a Western-style national debt problem in the headlines, but it has something arguably more dangerous: local government debt. For decades, Chinese cities and provinces funded roads, railways, and stadiums through special financing vehicles. These were essentially shadow entities that borrowed on the government's behalf without officially counting as government debt. Estimates from global financial institutions have put this hidden local debt well into the tens of trillions of yuan. Some analysts believe the true figure rivals or exceeds China's official national debt. Entire cities built infrastructure that sits half empty, financed by loans that assumed endless property growth. Ghost cities with completed apartment towers, empty highways, and stadiums that host almost no events became a quiet symbol of this borrowing binge. When the property market cooled sharply in the early 2020s, that assumption broke. Now local governments are stuck servicing debt on projects that may never generate the revenue that was promised on paper. Some provinces have reportedly had to delay salaries for teachers and civil servants just to keep interest payments flowing on time. This is debt that was never designed to be visible, let alone repaid on any normal schedule. It's the same rolling subscription model we saw with the UK and the US, just wearing a different disguise. Every major economy, it turns out, has its own version of this hidden gear. Now let's rewind further, past the world wars, past the founding of central banks, to something almost nobody covers: the South Sea Bubble of 1720. Britain owed a fortune after years of war. Instead of raising taxes, the government struck a deal with a private company, the South Sea Company, which agreed to absorb the national debt in exchange for a monopoly on trade with South America. The company's stock price exploded on pure speculation, since almost nobody could actually verify the trade profits it claimed. Everyone from servants to scientists, including Isaac Newton himself, piled in. Newton reportedly made a tidy profit early, then went back in during the mania and lost a fortune when the bubble collapsed. He's said to have remarked that he could calculate the motion of heavenly bodies, but not the madness of crowds. That single sentence, almost 300 years old, is still the most accurate description of sovereign debt psychology ever written. Because that's exactly what modern government debt runs on. Not physics, not mathematics alone, but the madness or the calm of crowds. And it's worth noting the South Sea Bubble wasn't an isolated madness either. Around the very same years, France ran an eerily similar scheme through John Law's Mississippi Company, which also collapsed the national finances almost overnight. Two of Europe's major powers, running the same experiment in parallel, arriving at the same painful lesson within months of each other. So why doesn't this collapse happen constantly, everywhere, all the time? Because governments and central banks have built layers of protection around that crowd's confidence. Layer 1, diversification. Debt isn't held by one lender who might panic. It's spread across millions of pension funds, insurers, banks, and everyday savers. A single panicked seller barely moves the market. It takes a coordinated loss of faith to break it, and that's rare. Layer 2, legal and cultural weight. Defaulting on debt isn't just a financial event. It's treated as a national humiliation. Governments will raise taxes, cut spending, even trigger political crises before they willingly default, because the reputational damage outlives any single administration. Layer 3, and this is the big one. Central banks can simply buy the debt themselves. When investors get nervous, a central bank can step in, purchase bonds, and inject new money into the system to keep interest rates from spiraling. This is what happened at scale after the 2008 financial crisis. And again in 2020, when central banks worldwide bought trillions in government bonds to keep economies from freezing. It's not printing money in the cartoonish sense people imagine. It's closer to an insurance policy the system writes for itself, using its own signature as collateral. But here's the catch. Nobody likes to say out loud on the news. Every time that insurance policy gets used, it changes the value of the money already in everyone's pocket. That's what inflation actually is, in one of its purest forms. The quiet tax that falls on savers so that borrowers, including governments, can keep functioning. In 2021 and 2022, much of the world got a very visible reminder of exactly this, as inflation surged after years of pandemic-era borrowing and money creation. Grocery bills climbed, rents jumped, and suddenly a topic that used to live only in economics textbooks was sitting at everyone's kitchen table. So who really pays for a debt that's never repaid? Not future taxpayers exactly, not in the neat way politicians describe it on campaign trail speeches. It's paid, slowly and invisibly, by anyone holding cash or fixed income while the money supply quietly expands around them. It's paid by a retiree whose pension buys a little less bread every single year. It's paid by a young couple watching home prices outrun their wages, because cheap borrowed money inflated the asset markets long before they could get in. It's paid by a student graduating into a job market where wages haven't kept pace with the cost of the very education that was supposed to secure their future. Debt doesn't disappear. It just changes shape and finds a new person to stand under it. Now, does that mean the whole system is a scam waiting to implode? Not necessarily, and I want to be fair here, because this system has also done something remarkable. It financed the roads, hospitals, schools, and technologies that built the modern world. The interstate highway system in the US, the National Health Service in Britain, Japan's bullet trains, all of it leaned on borrowed money that was never meant to be paid off in a literal sense. Even the internet itself, in its earliest form, grew out of government-funded research programs financed the same way. Debt, used well, is a time machine. It lets a society borrow prosperity from its future self to build things today that make that future genuinely richer. The danger isn't debt itself. The danger is debt that funds nothing productive, borrowed purely to avoid hard choices in the present. That's the line between Japan's decades of low-yield, productivity-linked borrowing and Lebanon's collapse or Argentina's repeated defaults. One borrowed to build, the other borrowed to survive one more year without changing course. Japan is actually the strangest case of all, and it deserves a moment of its own here. Japan's government debt is over 250% of its entire economic output, by far the highest ratio among major economies. And yet, Japanese government bonds are still considered some of the safest assets in the world. Why? Because most of that debt is held domestically by Japanese banks, insurers, and citizens themselves, rather than by foreign creditors who might panic and pull out overnight. It's a reminder that who holds the debt can matter just as much as how large the debt is. So here's where I land on all of this, and you're welcome to disagree with me in the comments. I don't think the question, will the debt ever be paid off, is even the right question anymore. I think the right question is, who is this borrowing actually serving right now today? Is it building something the next generation will thank us for? Or is it just keeping an old, tired machine running for one more election cycle, one more news quarter, one more comfortable illusion? Because the South Sea bubble didn't collapse because Britain borrowed money. It collapsed because the borrowing became detached from anything real, floating on pure belief with nothing underneath it. Lebanon didn't collapse because it had debt. Almost every country has debt. It collapsed because the gap between the promises made and the value actually created grew too wide to hide any longer. That's the pattern hiding underneath every single example we've walked through today. Rome debasing its coinage to pay soldiers it could no longer afford. Weimar Germany printing its way through reparations until wheelbarrows carried more value than the cash inside them. Argentina's endless cycle of borrowing, defaulting, and borrowing again. Zimbabwe, in the late 2000s, printing currency so aggressively that trillion-dollar banknotes became almost worthless souvenirs rather than money people trusted. Different centuries, different currencies, same underlying story. A promise stretched further than the reality behind it could hold. So when you next hear a politician promise to pay off the national debt, you now know what's really being said. It's not a plan, it's a slogan aimed at people who were never told how the machine actually works. The real plan, the one every finance ministry on earth actually follows, is to keep the wheel turning, keep the next buyer showing up, and keep growth outrunning the interest bill for as long as humanly possible. That's not a conspiracy, it's not secret. It's just rarely explained out loud because we're going to responsibly manage an unpayable debt forever doesn't fit on a campaign poster. And maybe that's the most honest way to end this. Debt isn't a monster hiding under the world's bed. It's closer to a language, one every government speaks fluently, one that lets society build now and settle the bill gradually across generations, as long as trust holds. The moment that trust breaks, in Lebanon, in Weimar Germany, in 1720 London, the language stops working, and the bill comes due all at once. What all of these stories really share isn't the size of the number. It's the moment ordinary people stop believing the promise would be kept. That moment is always quiet at first. A few nervous sellers, a few canceled contracts, a slightly higher interest rate demanded on the next auction. And then, almost without warning, it isn't quiet anymore. That's the pattern worth remembering long after you've forgotten the trillion-dollar figures in this video. Not the size of the debt, but the health of the belief holding it up. So the next time you see a headline about a country's debt hitting a new record high, don't just ask how big the number is. Ask a better question. What is this debt actually building? And who, quietly, is standing underneath it when the bill eventually lands? Ask whether the money is laying railroads and training doctors or simply papering over decisions nobody in power wanted to make. Because in the end, every one of these systems, from 1720 London to modern Beijing, from wartime Britain to present-day Washington, runs on the exact same invisible currency. Not gold, not oil, not even the paper the bonds are printed on. Just trust, renewed one bond auction at a time, one generation at a time. And trust, unlike money, can't simply be printed when it runs low. It has to be earned, protected, and every so often in history, painfully rebuilt from nothing. If this changed how you think about the money in your own pocket, you know what to do. Subscribe, and I'll see you in the next one.